I have a client that is worth probably $60 million and he's not going to leave a dime to his kids. It's all going to charity. So, I don't have to do a whole lot of estate planning for him on any of the sales of his businesses. So it kind of works out on my ass. But again, we're going to look at personal preference first, and then we're going to look at tax strategy second.
Good afternoon. I'd like to thank everybody for coming. My name is Jamie Garabedian. I'm the founder of Assurance Wealth Management. We host these webinars once a month with different specialists to talk about what it is that they do and how it can help you. This afternoon, we've got Rachel Knapp, who is a CPA with RMDs Accounting. So she works closely with individuals and families. She also works with business owners to provide not just tax preparation and filling in the boxes, but tax planning and how to help you save on taxes. And that's what today's all about. So Rachel, thank you again. I know we've done a couple of these together, and I want to thank you every time for coming in and sharing your expertise with us all.
Of course, happy to. I know it's been a busy month with my firm with all the year-end planning and strategizing and running all those last-minute numbers. That way, whatever moves that can be done are done by the end of the year.
Absolutely.
So, it's Christmas time, so everyone's spending money. So we find ways to try and make some of that spending a little tax-friendly. So yes. So I'm just going to kind of dive in because I'm going to cover a varying degree of topics. They kind of range from very basic things to very specific things. And I'm going to try and cover a lot. I might get a little technical. Some of it may not apply to you. I always have to put this in of I am not giving you tax advice right now. I am educating you on random other tax strategies that are possibly available for you because.
And I would like to double down on that disclosure for everybody. Listen, yes, I'm a financial advisor. Yes, she's a CPA, but as of today for this video, for this presentation, we are not your CPA or your advisor. Okay. This is purely for educational purposes. Please do not take what we're going to tell you here and go off and run with it. Please talk to a professional before you implement anything that we're going to talk about. Keep in mind that today's kind of goals are very simple. We're going to discuss what you need to have done or some ideas of what you may need to do before December 31st and what can kind of hold off until after the new year. So that way you don't freak out and try to rush and get a whole bunch of things done because some of this can be done prior to the end of the year. Some of it can wait for next year. And listen, we know we have a lot of different types of people here. We've got W-2 earners, we've got business owners, we've got families, we've got retirees, pre-retirees. There's a lot of different people here. And so we are going to go through and try to make sure that we clarify kind of who each strategy and what each topic, who they're for. We are going to cover something for everybody in this. And then at the very end, we're going to go through kind of some of the changes that, our one big, beautiful bill has made some changes for us and the good, the bad, and the ugly of what that looks like. So, let's just kind of dive in, Rachel. When people talk about year-end tax planning, what is it that you see the most questions around or the commonly misunderstood things when it comes to year-end tax planning?
So the big one that we always focus on in year-end are completing Roth conversions, because those are one that you have to do that by the end of the year in order to include the income into this current tax year. Even if it doesn't get done until January 1st, which I doubt because the market's closed, but January 2nd, then guess what? That's a 2026 problem, not a 2025. So at this point in time, what we're doing is we are really estimating everyone's income because it shouldn't change too dramatically between now and 15 days when the year is over. So this is the time where we're really chewing down, diving in and seeing what numbers can be played with. For retirees, especially that Roth conversion, we're playing around with called IRMAA brackets, which are related to Medicare premiums. Because most people with the Roth conversions are trying to maximize the 24% tax bracket. But within that bracket, there's 3 different IRMAA brackets. So it becomes kind of a catch-22 on that front. I feel like the government kind of saw that happening and realized, we can make some money off of this. So we have to kind of play around with different levels there. So it's a lot of estimating. We also factor in charitable of, hey, if you donate X amount of dollars, this brings you back down to a marginal bracket of 24% or maybe 35 to 32 or even 32 to 24 because that's the biggest jump in our tax brackets there. So that's another one. And sometimes it's not as simple as, okay, let's donate to Wounded Warriors or the National MS Society. It's how about we get a donor advised fund set up real quick, and that way you can offload money there, and then later the money can go to designated charities, but you still get the charitable contribution when you put it into a donor advised fund. Another. Go ahead. Okay. I was also going to say on employer benefits, we also want to make sure that we're maximizing our retirement contributions there, whether it's a traditional 401k, a Roth 401k, solo 401ks. Your employee portion has to be funded, but the employer portion can wait a little bit on that one. But there's certain ones. We also want to look at making sure your FSA, because you need to check with your employer, because some employers do allow a grace period up to 2.5 months into the new year that you can still utilize your unused benefits. But you also want to make sure that you're all signed up for your benefits for the next year. Those are some of the big ones that we tend to run into for year-end planning.
So before anyone kind of starts this year-end move or makes anything big changes, I mean, what kind of key numbers or pieces of information do you typically ask them to bring in or that they should have available before kind of making these decisions?
We always look at last year's tax return to kind of give us a good roadmap, make sure that we're not missing a key piece of information. Maybe you're invested in a hedge fund or something like that does put off phantom income that may throw everything out of proportion compared to what we think it should be. Because a lot of times with hedge funds, you have absolutely no idea how much income is going to come through until you get the K1, which doesn't usually happen until August of the following year. But we also ask for most recent pay stubs. That way we can kind of get a good piece. If there's any outstanding bonuses or compensation that are coming in, we look at that. Business owners, we want to make sure that their books are up to date first off. And if not, then we try to get them as cleaned up as possible to run an accurate estimate to see currently where do they stand and what wiggle room that we have.
And so kind of transitioning and starting with kind of the broad base of W-2 earners, retirees, families that have investment income. I mean, how should these families or individuals start thinking about tax bracket management as we approach year end? I know that you were kind of mentioning, you know, if you do Roth conversions, filling up that 24% bracket, but how it screws with the IRMAA levels, you know, just what is your kind of take on tax bracket management?
Ooh, that's a hard one. Sometimes, the numbers are what they are. Like you all of a sudden, if you have a base salary of $400,000, and then all of a sudden you get a bonus that's going to be $200,000. Well, now we're no longer going to be in a 24% bracket. And I'm going to assume married filing jointly in all these scenarios. For you single folks, just slice it in half. Had a household, we'll talk separate. But just kind of give you a key idea of where these numbers align. I always start with married filing jointly just because that's the most common filing status that we come across. We like to do the 24% bracket overall is the largest one. It ranges from about $210,000 to about $450,000. And then it jumps from 450 up to the 32% bracket, which is a hard pill to swallow. But I want you guys to also remember that our brackets are tranches. So your first X amount of income is 10%. Your next one is 12%, then 18, then 24, then 32, 35, 37. So a lot of folks get a little worried if they move up a bracket that the entire amount is going to be taxed at that new bracket. And it's not. It's just the income over that excess that gets taxed at the new level. And then there's also the fun thing is throwing in capital gain taxes because qualified dividends and long-term capital gains are taxed at a more favorable rate. Depending where you're marginal, which is that 24%, 32% that I was going over, that kind of determines where your capital gains brackets are. Most people find themselves in a 15% capital gains because that's, again, the most common one. Others that are in the high net worth getting into the 32% or so run into 20%. And there is this magical number at about $400,000 of taxable income that you run into all these surtaxes and things like that. So there's the net investment income tax, there's the Medicare tax. It gets a little bit harder. And there's specify on Medicare tax, every W-2 pays a Medicare tax. There's an additional amount once you hit over that threshold.
And to clarify, that 400,000, is that 400,000 in capital gains or is that 400,000 in income?
Income. So ordinary income. So your earned income, wages, business income, interest income, ordinary dividends, not qualified. So yes.
And so you talked a little bit about bonuses and some different ideas if people are still working. I mean, I often hear about people asking questions about accelerating income or deferring income. When does a strategy like this make sense? And have you seen it, or how can it actually create problems for people if they don't do it correctly?
Mm-hmm. Again, it comes just down to estimating and kind of knowing where we are. I just lost my train of thought. It just comes down to estimating in the end. So we're kind of looking at, okay, where we are now. If we know in the following year, you're going to have a big promotion, your new base salary is going to be X amount of dollars, then we do kind of maybe want to look at doing accelerating the income in order to fill up the bracket instead of going over completely into the next bracket. In the following year if our income's higher. Same thing with deductions. If we're in a high income year compared to other years, just because it just was a fantastic year, you got a large bonus, then we do look at accelerating deductions to try and offset some of those things. So it is, again, you just have to actually watch it. It's not, taxes should never be do a tax return and that is it. Taxes have to be something that you watch throughout the year and that you're keeping track of. Because if you don't watch it, you will have a lovely surprise come filing time.
Oh, yeah. We got a couple of questions in about the tax bracket and where people fall in it. So I had one saying, is the tax bracket based off of your AGI or is it the amount shown on your W-2?
The tax bracket is based off of your taxable income, which is going to be your adjusted gross income plus or minus adjustments to gross income, which could be HSA deductions, IRA deductions, jury pay, which I'm not real sure anyone actually reports jury pay, to be honest. That $6 check is really going to hurt you. There's some other things on there that you might just one off. Sometimes court cases, settlements will be an adjustment to gross income along with attorney fees if they're a taxable award judgment. So those are all things that factor into your adjusted gross income. You then reduce your adjusted gross income by either the higher of your itemized deductions or your standard deduction. And the standard deduction is based on your filing status. Your itemized is going to be a combination of medical expenses if you're over your AGI limitation, your real estate taxes or state income taxes. I know I see some folks out here that don't live in Texas. For you guys. And then charitable contributions. And there's some one-off items there and there. So whichever one is higher, you take that and that reduces your adjusted gross income. That produces your taxable income. And that is where your tax bracket is determined from. A lot of algebra.
So we have our adjusted gross income adjusted again by a bunch of other things. And that creates your taxable income. So yes. Hopefully that answers the question. The second one is, does the sale of rental property count as earned income or where does that fall in as far as taxable income is concerned? Oh boy,
so I'm going to preference this with real estate has its own bucket of rules. Depending on how your real estate was treated, if it was treated as a trade-in business compared to a rental business itself. If it's a rental business, it's going to be treated as long-term capital gain if it met that 1 year and 1 day ownership test. If it wasn't, then it's going to be short-term capital gain. But either way, rental income, if it's going to be in the rental income bucket, then it's not going to be considered earned income. If it fell into the trade and business bucket, then it will be considered earned income.
So it's going to be how they position it, essentially.
How you position it, yes.
And how long they've held on to it.
Mm-hmm.
So if your taxable income is between $220K and $230K, which tax bracket are you in?
Married filing jointly, you're going to be right on the cusp between 18% and 24%.
So that's again going to depend on your filing status. So head of household, single, married filing jointly, they're all going to be a little bit different.
And then there's married filing separately on top of it. But yeah, there's a few different ones. How about single? Single, you'll be in 24%.
And so, kind of moving on from the tax bracket conversation, you mentioned a little bit about capital gains. What have you seen as far as best practices when it comes to capital gains and maybe offsetting some of that, especially with volatile markets like we have now?
The big one is going to be tax loss harvesting, which is basically if you have a large capital gain and then you have some loser stocks that you're trailing at a loss, you could sell them at the loss to mitigate your capital gain. We typically do this, especially for short-term gains, because they're taxed, again, at your marginal bracket compared to the long-term gains, which are going to be that preferential tax treatment.
And I'll kind of throw in here because this is a little bit more about what we do than it is what the CPAs do. When it comes to your investment accounts, if, right now we're at the end of the year, if you have a bunch of holdings in there in a non-qualified account or a brokerage account, and you see a bunch of these holdings that have losses, there's no reason not to sell them right now. Even if you don't have any realized gains, there's no reason not to sell them and recognize the losses. Now, we can recognize up to $3,000 in losses per year, but you get carry forward losses that you can now recognize somewhere down the road. And if your portfolio is doing what it should and has gains in some future year and it doesn't this year, you're going to want to have those carry forward losses to offset any of those gains if you can. The second thing I'll say is about kind of allocating your money and not just, diversifying across funds or across equities and fixed income, but having the right types of strategies in the right types of accounts. So typically what I mean by this is non-qualified or those brokerage accounts are a great place to have capital losses created, even while growing your portfolio, whether it be through tax loss harvesting, or there's people that use option strategies or long short strategies, or there's a million different ways to do it. But you want to take advantage of the fact that a non-qualified account can be used for tax mitigation or help you with your tax brackets. And then your retirement accounts, your qualified, your IRAs, 401ks, that's where you want all your growth to come in, because you're not going to get penalized or taxed on that every single year that it grows. So that's my 2 cents on the investment side when it comes to taxes and making sure that you are setting up your accounts properly and have the right strategy and the right type of account. Now, when people are kind of coordinating their investment decisions, and you mentioned a donor advised fund earlier, but when we're looking at all charitable giving, so anybody that's charitably inclined, how do they coordinate those investment decisions with charitable giving so they're not kind of working against themselves from a tax point of view?
From the tax point of view, it doesn't really matter if it's going to be cash or in kind, which could be stock or, donating furniture type of situation. We do tend to say, okay, if we have a very appreciated stock, so maybe it grew 300%, and you're looking to donate a similar amount of money, we're like, hey, why don't we donate the stock instead? That way you don't pay the tax on the capital gain in order to liquidate it to give the cash to the church or whoever it is. So the donor advised fund, though, is a fund that's going to be held by a custodian. So, either Schwab, Fidelity, Raymond James, one of those. And you put either, again, cash or stock or equity, bond, or whatever you want to call it, into this fund. And then it's held on by the custodian. And eventually the money will go to a charity. Technically, the custodian has full right to decide which charity it is. But for the most part, I haven't seen once where the custodian disagreed on the charity. So just kind of put that ease at mind there. But yeah, that's pretty much it. And like I said, when we're looking at years of higher income, we sometimes look at accelerating charitable contributions. Now, I know this year is particularly a little different because I'm going to get into the OBB, the One Big Beautiful Bill. Hate the name. Such a mouthful. But yes, so I get into that one specifically because there are changes to charity that are happening into 2026 that for especially my high net worth and high income, we are looking at accelerating charitable contributions because they're going to probably lose some of it going into 2026. Because again, when we get to this particular thing, once your adjusted gross income hits $500,000, you're going to start getting a reduction in charitable. If you're also in the 37% tax bracket, which is the top bracket, they're also only going to allow you to have 35% benefit compared to 37% benefit. So we're going to see a little bit of a decline for the high income that do quite a bit of charitable. And it's for that reason. And so some of those were like, hey, if we maybe double up donations this year, you're going to get a $40,000 tax break compared to spreading it between this year and next year. So there is a little bit of that, which comes down to, again, we're just watching what your numbers are looking at and seeing, moving the pieces around, because in the end, taxes are a chess game. And so it is all strategic, and we're looking to, basically take down the IRS at that point. So yeah.
Nobody, you have no moral obligation to pay as much as you can in taxes. So when it comes to like the retirement related moves for people that are still working and things like 401k contributions, IRA contributions, HSAs, what kind of moves need to be reviewed now? And then what can we wait on till the new year?
So the retirement contributions, if you are working still and you're on the 401k, those all need to be completed by the end of the year. So you need to fully fund however much you want to put into your 401k. Also keep in mind, those that are above 50, you have a catch-up contribution, so you can kind of put in extra money. Most people tend to set that up to just kind of be evenly taken out throughout the year. But if you're looking to kind of maybe defer some taxes, that would be the way to do it. However, I will say that the baby boomers have been a lovely little experiment for us of pre-tax accounts kind of coming back and biting us in the butt in retirement years. We're finding out that, the 1986 tax code allowed the pre-tax accounts, and that they kind of advertise, oh, you'll save so much more in taxes as if you defer during your working years compared to when you retire, you're being a low bracket. We fast forward, appreciation, taxes only went up. Retirees now are actually paying more in taxes than what they saved in their working years from these pre-tax accounts. So we are kind of switching over to do the Roth 401k instead and take the tax hit now, because when you retire, then you won't be paying taxes on your retirement account. Assuming nobody doesn't touch it. There's always that caveat there.
and nobody, can see the future, but I think we all can agree. And I think pretty much anybody I've talked to, no matter what side of the aisle they're on, can agree that with our debt as high as it is, it's just ridiculously high and only growing faster. The only way the government makes money is on taxes. So, 1 + 1 = 2. They're going to have to raise taxes if they ever actually want to pay down the debt. So it's just one of those things that we are going to see increases in taxes no matter who gets in office, whether it's the next election or the one after that. We're going to see it, soon. They're going to have to. So keep that in mind when you're trying to decide between pre-tax and post-tax, Roths, non-qualified, all that kind of stuff. There's a lot of different ideas and strategies out there around it. So make sure you get with somebody who knows that. And Roth conversions come up a lot. And hey, have you ever seen situations where, because obviously they do make sense for a lot of people, but have you seen situations where maybe they don't make sense, or there's hidden downsides that people need to be aware of when doing Roth conversions?
Typically, the people that we don't see the Roth conversions for are those who don't have any children, and they plan on leaving their IRA to charity afterwards. And it's simply because when we factor in inherited IRA rules for a married couple, the second to die, especially, the adult children are going to get hosed on the taxes at that point, because they have to take a portion out over a 10-year period until it's all empty. And so when we factor in the inherited IRA taxes, we tend to see it makes a lot of sense to do as much Roth conversion as possible. But if the inherited IRA taxes aren't at play and it's maybe $120,000 RMD that we're looking at, nothing horrifically high up there, then we tend to kind of leave it alone.
And you spoke a couple times now about donor advised funds, and, there's considered like bunching strategies, or you bunch up a whole bunch into the donor advised fund. When does that make sense versus giving annually?
The bunching, like I said, it's usually when it's an off off income year. You have extra income in one year compared to the other. Or like I said, it makes sense because you're going to be getting some of the phase outs into 2026. So maybe we accelerate a bit more in 25 as a result of that. And some people just very much are like, this is what I budget for. This is what I'm doing. There's no changing their minds. So that is what it is. Another strategy that retirees have, especially if you're 70 and a half or older, is qualified charitable distributions, where the money goes straight from your retirement account to a 501c3 entity. It does have to be a 501c3 entity, just kind of keep that one. But that removes it from your income completely. So it's not even really necessarily a charitable deduction that you have to worry about, because it's going to lower your income completely, which if IRMAA brackets are a problem for you, that's a good strategy to go with compared to taking the money out of the retirement account and then writing a check to a charity, because that may not, the standard deduction may be higher compared to your charitable. So you basically didn't get a tax benefit for your charity.
Well, let's shift gears a little bit to the business owner side of things. And then, once we go through some of these business owner questions that we've got in, we'll come back to the one big, beautiful bill and see how it affects everybody. Ooh, actually, we're going to answer a couple questions right before we do that. I just saw these come in. All right. Question number one. If we have held a traditional IRA for years and want to convert that to a Roth or backdoor Roth, can you pick and choose what to convert, or does it default to the oldest shares you have? Would you recommend just starting a new traditional IRA and then converting into a Roth the moment it's invested into the traditional IRA, and leave the old IRA alone?
Ooh, this is a good one. Okay. So little education on backdoor Roths. The way backdoor Roths work is you put money into a traditional IRA that has a value of zero. And like the next day or maybe a week later, you roll it over to a Roth IRA. You want to do it before any earnings happen, because earnings would have been taxable. But if you're putting in money, your basis is coming out. You can't elect first in, first out basis. You can't elect last in, first out basis. You just have to make the election. However, on backdoor Roths, we have to go into this particular little situation. The IRS views all IRAs, so all traditional IRAs, as one. So if you have an account with $100,000 and then you have an account with zero, well, they're going to see it as you're converting the 100,000 and the zero collectively. So you're going to be taxed on your backdoor Roth at a prorated amount. So it's very tricky, and you have to kind of make sure that we have everything, the ducks in a row. Sometimes what we see is if we can move an IRA into a 401k, see if we could do it that way. But a lot of employers don't allow that. They don't want to take responsibility for money that wasn't earned by them. And so sometimes too, we will leave a 401k with an old employer that way it opens up the backdoor Roth, but there is an opportunity cost. And Jamin will probably argue with me of no, move it over to the IRA. The opportunity cost is better to do it in the IRA. But from a tax standpoint, it hurts.
So I'll agree and disagree with you. We'll put it that way, because there's strategy. It depends on the rest of the strategies that you're using. So there are ways to offset some of those, but that's a whole nother conversation to have. And so I will ask this kind of on top of that is, if somebody wants to take, let's say they have a highly appreciated stock with a low cost basis in an IRA and they want to move that over to the Roth, at what level is it actually taxed at? Is it at the appreciated level, the cost basis level, some mix of the, in the middle algorithm? Because we know the tax laws like doing those. So how is that appreciated asset taxed?
It's going to be at the fair market value. So if you have the appreciated asset, it's going to be whatever the asset value is.
On the day of the conversion.
On the day of conversion, yes.
Okay. Yep. And then the next question we got, can you accrue a charge end of year to be paid at a later date to a donor fund, or is the deduction available to cash only? So
if you're looking at putting stock into the donor fund, it does need to be completed by the end of year. So whether it's cash or security, it does have to be in the fund. You can't open it and initiate it, and the initiation happens after the year. Donor funds are a very particular set of rules for that reason. However, if you write a check to a charity and you date it 12/31 and they don't deposit until January 2nd, it's still a 1231 donation. That's a little bit of a difference there with the donor advised funds.
Now let's fast forward to or shift gears to the business owners. How should business owners think about entity structure, S corp partnerships, sole props, all that kind of stuff when doing year-end planning?
The year-end planning. So the entity structure, you're going to want to work with the attorney, just from a liability standpoint. Most folks, when they're business owners, they form the LLC, and an LLC can be a variety of different things. It could be a sole prop, it could be an S corp, it could be a partnership, it can be a taxable corporation, it can be pretty much whatever you want. We tend to switch to the S corporation from a sole prop to an S corporation when it's about $100,000 in profit. We do this analysis based on different strategies, though. Retirement's a big one. So if you're doing a SEP IRA or a solo 401k and it's tied to your profit, okay, if you switch from a sole prop, which means it's just directly on your Schedule C on your individual tax return, it's basically 20% of that profit. You switch to the S corp, though, that it's 25%, but it's 25% of your wage, but you have to pay yourself a wage out of the S corp. So that becomes kind of the caveat there of how much do we want to defer into retirement? Because the whole reason why we try to do the S corp is to avoid self-employment earnings, which is employee and employer share of Social Security and Medicare tax. And so we typically go to the S corp and we do a low wage to meet the IRS standard, but then that does limit retirement contributions. So then we have to maybe increase that, which then kind of caps back that tax that we're trying to avoid. So it becomes a very much a catch-22 of where we're doing that. I love LLCs. I always recommend them to everybody if they're doing any kind of business or a little bit of liability. Just because, at least here in Texas, they're $300 to form and you have a really good liability protection for yourself. Other states may not be as much. I think Texas is ranked number 7 in LLC friendliness, simply because we don't do anonymous ownership. We have public information. But yes. But in terms of the taxable corporation, I tend to leave that alone for companies that usually technology companies that plan on selling after about 5 to 7 years, simply because there is this lovely little loophole called qualified small business stock exclusion that you could get up to $10 million of a capital gain tax-free if you meet certain criteria. And that criteria, the number one criteria is it has to be a taxable corporation. So, but other than that, we don't tend to use corporations that much.
And you mentioned a little bit about the when you're an S corp and you have to pay yourself a salary, or reasonable compensation for the payroll tax side of things. What are common mistakes that you see around that reasonable compensation?
The biggest one is they don't pay themselves a salary. That's the big one there. And usually the IRS allows about 2 years, or if you're running a loss, they usually will forego a salary for that reason. That's the big one. The second one is not paying themselves the actual salary. They're just filling in paperwork and not actually doing it. And I'm like, well, you actually have to do the money transfer there. So you have to have a paper trail. Anything with the IRS, there's going to be a paper trail unless you want to get caught. So that's kind of the strategy there. But yes, but there are some things too with if you have other employees, so you hire other family members, things like that. If you have children under the age of 18 and mom and dad own the business and it's a partnership or a sole prop, kids under 18 don't have to have payroll tax withheld. So that's a good strategy there to paying your kids. Again, you have to pay them. You can't just put it on paper. But that's a good strategy. And you have to justify that they're working, which I always tell people, hand them a cloth, have them wash the baseboards around your office. I know we do that with, a couple of toddlers and they just think it's the best thing ever. And you know what? We're not violating child labor law, so it's okay.
I will vouch for that one. I've actually got a 3-year-old here in my office right now because he's sick and home from school and he is shredding papers right now.
Yeah, it worked out.
And so when it comes to those wage designations for the S corp, is that something that you have to document or clarify somewhere how much you're going to pay yourself, or is it just pay yourself throughout the year and it can be changed? So what does that look like?
It's pay yourself throughout the year and it can be changed. For most of my clients, we set in low salary for quarters 1 through 3. That way we just know what the payroll taxes are going to be for that reason. Quarter 4, we look how the business is doing. Do we need to gross up wages for retirement reasons? Or another one is qualified business income deduction, which has a wage threshold put into it. The qualified business income deduction is small businesses are allowed to deduct 20% of their profit or 50% of their wages, whichever is greater once you hit a certain threshold. And so for that one, we tend to bring in the wages for that reason, try and bonus up wages to qualify for the largest deduction that we can. Otherwise, if we look at it and we're saying, oh, you know what, wages are fine, profit's not that high this year, we leave it alone and we don't even need to pay anything in quarter 4. So again, it's just watching. I'm going to just say this over and over again, watching.
Keeping an eye on it.
Your cash.
And does the traditional advice of accelerating deductions and deferring income still make sense for business owners today?
Not necessarily the deferring the income, because I think you're talking about maybe the accrual versus cash basis of accounting. And most people are on a cash basis. And so once you receive the money, it's done. There's no going back to that. Same with deductions. Once it's paid, it's done. We tend to do the accrual method for particular businesses. And once you're over a certain income threshold, you have to do accrual method, which is you're taxed on the income once you bill out for it, whether or not you receive it. And same with deductions. It's what you get the bill for. It's an expense, whether or not you paid for it. So those are the things that we tend to do there. But again, it comes down to where you're standing on your individual income taxes, because if you're an S corp or a partnership sole prop and it's flowing to your individual level, maybe we do look at, hey, why don't you move that bill or that invoice a couple weeks out into January, because we don't want to bring in $40,000 of income this year. And a lot of people will do that. And so if we can find that little wiggle room by the end of the year, we're going to do it, just to kind of keep our taxes low, especially if we have like a certain amount that we're playing with, like, hey, you have $20,000 for a tax payment this quarter. Let's stay within that $20,000 tax payment. What can we move around in order to make that happen?
Do you see any common deductions that are missed or planning opportunities you see are missed by business owners?
Oh, yeah. There's a lot of things. Basically, if you bring it, if it's money spent on the business, it's going to be an expense. There are some caveats that entertainment was completely nixed back in 2018. So if you buy tickets to a ball game to take a customer, you're not going to be allowed to expense that for tax purposes. Meals with clients, things like that, that's only going to be 50% deductible compared to the 100%. But I will say, bringing food into the office to feed your staff so they can keep working, 100%. So I always tell people, if you might want to just cater it in instead of going out instead for that staff meeting. So there's some things there. We also look at mileage, using your car, cell phone use, things like that. Home office use is a big one too. But again, it depends on where income is and things like that, how aggressive we want to get on it. Mileage is a very red flag for the IRS, and they will audit that one. And they do want basically a diary of every trip that you took, how, what address to what address, total miles, what you were doing for that trip. So if you don't have that information, if they audit you, they will just completely get rid of that deduction.
And if that's something that you guys do, there's 100 apps out there that will track your mileage and let you leave notes. And you don't have to do anything other than start trip. And it goes from where you're at to where you finish. You click end trip, and it counts all the mileage that you went. So it's very simple to do. Don't let that be a reason that you get audited or fail an audit, is because you don't have a log of that. There's so many apps out there that can help you with that, and they're very easy. When it comes to the business owner's retirement planning or retirement plan side of things, like solo 401ks or cash balance plans, when those are part of the tax planning, how is it that you evaluate what type of plan they may want to get into?
We look at a few different things. We look at the timing of when the contributions have to be made. We look at the expense of the plan, because SEP IRA is usually the most common for a self-employed individual. And it's because you can open up one online and put money into it. Very easy, very manageable. Solo 401k, you're going to have a custodian for. You also have to file a Form 5500 every year on it to disclose how much of the assets are in there. Same with cash balance and things like that. Now, I will say cash balance, solo 401k, you can put more money into it year after year compared to the SEP IRA. But again, it may be more expensive. So if you're a high income earner, that's going to be from your business, then we probably will look at more of the solo 401k or the cash balance. We also look at, do you have employees? Because that's a big thing as well. Because you cannot do a solo 401k if you have employees outside you or your spouse. If you do the cash balance plan or a regular 401k, you have to make it available to all full-time employees. So you're eligible for it, so is your other employee. Now there are things like you have to meet full-time status, things like that. You can kind of squash it a little bit, but there's very strict rules on retirement plans. So we have to kind of look at a varying degree of items and circumstances that are going on. We also look at, too, you can still do Secure Act 2.0 allowed Roth component for all of these retirement accounts. I will say some of the custodians do not have available yet some Roth components of the accounts, like the simple IRA is one that no one has a Roth available for it yet, even though it was approved back in, I think, 2022. So we're still waiting on that one. Apparently the SEC is holding it up. Thank you.
Surprise.
Yeah. So it all comes down to a varying degree of circumstances specific to your individual return as well.
Sure. And I mean, and when we're going through this, listen, I mean, we keep talking, the second part here has been all about businesses and business owners, but anybody who is a business owner, your business tax planning really does need to coordinate with your personal wealth plan, your personal tax plan. You can't just see them as two separate entities and silos. They really do need to coordinate, because at the end of the day, it's all getting taxed to you, and it's all part of your plan for your entire, wealth management or retirement plan or financial plan. So it's something that all does need to coordinate very well. And so for business owners, kind of one of the biggest tax events of their life isn't necessarily while they're running their business. It's actually when they're exiting their business. They're eventually going to sell their business. And whether that's the sale of a business, transitioning it to children or maybe a key employee, or if you're going to IPO, I mean, there's a lot of different ways to exit the business, and they all have different tax strategies around them, and they all have pros and cons. So when an owner comes to you and says, hey, Rachel, I'm thinking about selling my business in the next, 1 to 5 years, what is the first thing that you're going to ask them? What is the first, from a tax standpoint, what's the first thing you need to know?
Goodness. The first thing I know is usually like, how much? How much do you think you're going to get? The second thing I'm going to ask them, do you have an attorney already involved? Because I'm going to point you straight to an attorney for any kind of asset sale or business sale, I should say. But just because you don't want to get hosed with any kind of fine print. The next thing I'm going to ask is it going to be an asset sale or an equity sale? Asset sale is selling the assets or the name of the business, but not the actual name itself. This is a more common one that we see, simply because the purchaser does not want to be responsible for past obligations, because if they buy the entire business, which is the equity sale, they're considered the new owner of the business. And if the new owner had left behind $100,000 of payroll tax delinquency, well, the new owner now has to deal with that. I'm sure there's things in the attorney would argue that, oh no, we put a clause in there, but then it's a thing. We just don't need to do it. So that's usually what. But I also look at the asset sale first, the equity sale, because equity sale is going to be 100% long-term capital gain. So it's going to be the more tax preferential one. asset sale is going to be a combination of ordinary income and long-term capital gain. It just depends on the type of assets. We also look at with asset sale, how much money we can shift over to each asset. And we try to put as much basis to the ordinary assets, like your accounts receivable, simply because we don't want to pay the ordinary income tax rate. We want the long-term capital gain. Things like goodwill, which is the name and your reputation of the company, are going to be taxed at long-term capital gain. So it becomes a little bit of a moving part. I will say that typically the purchaser wants more money on the ordinary assets. That way they can depreciate them a bit higher. And sometimes they qualify for bonus depreciation on top of it. So they get a better tax write-off on the ordinary, but the buyer does not get the better tax treatment. So it becomes kind of a finger pointing type of situation of which way we're going to go. But those are the things that we really watch for, and we try to negotiate and we try to plan accordingly. That way too, in case we need to front load some of those deductions that we were talking about, maybe we're pushing the sale into 2026 compared to 25. Okay, let's try to accelerate, maybe pay the bookkeeper in advance. That way we get bigger deductions then. So those are things like that we try to kind of strategize to reduce the ordinary income components of it all.
And I'll say purely from a tax standpoint, I think you'll agree with me on this one, Rachel, or at least I hope you will, if you're going to sell your business and you have the choice of when to finalize the sale, make it in January of whatever year you're going to sell it. Make it in January, because that gives you a full 12 months of things that you can do to try to reduce those taxes. If you sell in December, December 18th, you've got like 2 weeks to figure out strategies and reduce those taxes. So for any business owner that's looking to sell, if you have the option, if you have the ability, choose January to finalize that sale. And yeah, so we talked, you talked about the asset sale versus the equity sale or stock sale of the business, and just black and white. With an asset sale, are you capital gains or are you ordinary income?
It could be a combination of the two.
Okay. And with an equity sale, is it capital gains or is it ordinary income?
It's capital gains.
Okay. So just so everybody understands the difference between the two and how they're each taxed. And this goes back to what I was saying earlier, is that if you are a business owner planning to sell your business in 1 to 5 years, like we just mentioned, now is a great time of looking at those non-qualified investment accounts that you have and start stacking up some capital losses. Start stacking up as many losses as possible. And when I say capital losses, that doesn't mean the value of your account is going down. The value of your account can grow every year, and there are still strategies that allow accounts to grow while still recognizing capital losses. And this is good for these carry forward losses for business owners. In this case, if you go through an equity sale or a stock sale of your business, hopefully you've accumulated a lot of these capital losses that you can now use to offset the sale of your business. So, when it comes to strategizing and putting together a tax plan for the sale of a future sale of a business, do you have any specific timeline and when you think people should start planning and start looking at these things? You
want to start planning as far in advance as you possibly can. But I say that loosely because you never know what the purchaser is going to negotiate with you. Some things may be a definite no. Some things may be, okay, I'll agree to that just to keep the sale moving. But you still want to try and get as much information as possible. That way we can run different scenarios for you. Like, this will be your taxes if you do it this year. If you spread it out, you can do installment agreements where you get 50% up front, and the next 5 years you get another 10%. That way you just spread the taxes out. Because maybe in those final 5 years, you're in a low enough taxable tax bracket that capital gains is 0%. So there's different things that we can strategize here with that reason. So yeah.
And how should these business owners kind of think to coordinate estate planning, gifting, charitable strategies all ahead of this liquidity event?
So the estate planning, you're going to bring in that attorney. We do know an attorney that does business and estate planning. If you don't know Don Henderson, So I'll give him a shout out.
Say if you've been on these webinars before, you've seen him before. He was on here last month with us.
It's okay. You can have attorneys work with each other, even though they tend to not like each other. But it's okay. Estate planning, we're looking at, okay, what are we doing now with this money? Are we going to be putting it into a non-qualified account? Are we going to go ahead and write checks to the kids and give them an advance inheritance? You can also look at, okay, maybe I'm going to take this money and I'm going to put it into a family foundation. And that way I live on forever, or at least until this foundation dissolves. So there's different things there from estate planning. It comes down to your own personal wants and that what you want to see your legacy do, what you want your kids to have. I mean, I have a client that is worth probably $60 million and he's not going to leave a dime to his kids. It's all going to charity. So, I don't have to do a whole lot of estate planning for him on any of the sales of his businesses. So it kind of works out on my ass. But again, we're going to look at personal preference first, and then we're going to look at tax strategy second. Because if my tax strategy goes against your personal belief, well, then you're not going to do it anyways. And we just kind of all wasted time.
Well, let's zoom out. We're going to get to your favorite part of this whole thing. Let's talk about how recent tax law changes kind of fit into all of this. Now, at a higher level, we've talked a little bit about the one big, beautiful bill. What is the most relevant thing in there for individuals, families, business owners, or even retirees?
There's quite a bit. So I'm going to start with the business owners because there's probably more for business owners compared to the individual. The big one for the business owners is bonus depreciation is back to 100%. And it went into effect for assets that were put into service as of January 20th, 2025. They made this provision retroactive, which is great for 2025 taxes. So if you purchase a qualifying asset, say you purchase a bunch of computers, things like that, instead of depreciating them over a 5-year basis or getting what was 40% bonus, which means 40% of the value with a deduction up front, and the rest was depreciated over a 4-year period, now we get 100% of the deduction up front. You're going to see this a lot with vehicles. I don't know if anyone's seen some of the billboards out that are advertising, hey, purchase this truck and you get to write it off on your taxes. Yeah, you could. So if it's a 6,000 pound vehicle or higher and it's a business asset, you could write off the entire truck on your taxes for the year. You do have to purchase it, but you could finance it. So that's a little bit different. You just can't lease it. So that's the big one for businesses. Another one that we're going to run into for individuals, I went over some of the high net worth for the charity reductions, but the SALT limitation has been increased from 10,000 to 40,000. The SALT limitation is state and local taxes. So state income taxes, state sales tax, real estate taxes, personal property taxes for those states that have that. Now, instead of being limited at $10,000, it's $40,000 until your AGI is above $500,000. If you hit that threshold, it starts to phase out over the next $100,000, and then you're back down to $10,000. So that is a little bit of a difference there. So we're going to see more people itemizing it starting in 25 compared to previous years. I'm trying to scroll real quick to my little cheat sheet here.
Your little cheat sheet?
Yes. Another one that a lot of folks don't know about is car loan interest can be deductible now up to $10,000. That's a new one. The car does have to be assembled here in the U.S., though, and it starts to phase out once you hit $250,000 of AGI. And AGI, adjusted gross income, just kind of throw that into there.
Real quick on a clarification question, you're talking two different things on vehicles here. Does that vehicle need to be in the name of the business?
No, this is a personal vehicle only.
Okay. What about you're talking about the truck writing the whole thing off? Does that need to be in the name of the business, or can that be in the name of the owner?
It does technically need to be in the name of the business.
Okay.
So
just wanted to clarify that for anybody out there thinking about doing it.
Yeah. Person brings in commercial insurance and all that. There is a nice little trick with this one of where you lease your personal vehicle to the business. And so that way we can write off your personal and you would keep it in a personal. But there's some tricks. So again, talk to an advisor before we're actually doing that. We also have for OBB, we also have the old folks deduction. I know it's not technically called that, but whatever. So those that are 65 and over, you could each possibly get $6,000 in additional deduction to your standard deduction. However, it starts to phase out at $150,000 of AGI. So some folks may not see this as much as possible. There's also things on tip income being tax-free and overtime pay being tax-free. Again, all comes down to AGI of $300,000, the source of the income. So those are big ones. Child tax credit did go up by a couple $100. Unless your kiddo turned 17 in the year, then they get $500. I know that's going to hurt my own taxes because my oldest turned 17 this year. And
me too.
Good Lord, those are expensive children.
Mm-hmm. We got a question here. Can I write off any of my car which is leased because I use it for business as well?
As a fundraiser?
Yeah, I'm not sure I understand that question. Michael, if you could rewrite that, I'm not sure. Taking donors to dinner and etc.
Oh, okay. So there are charitable miles that you can write off, but only if you have enough to itemize with charity. Charitable miles, I think, are at like 30 cents a mile. They're not as big compared to like a business mileage, which is going to be, I think it's 70 cents for 2025. So it helps if you do a lot of driving for charity. You go ahead and keep track of it.
I know we're right up against that hour mark. We only have a couple more things we're going to go through right here, and then we're going to open it up to questions. So for those of you still here, please hang tight just for a little bit. We've only got a few more of these. Which of these changes in the Big Beautiful Bill are going to affect 2025 planning versus strategies that are going to move out to 2026 and beyond?
So the SALT limitation is up for 2025. The bonus depreciation for businesses is up for 2025. Pretty much everything else, or the old folks deduction is for 2025. Pretty much everything else is going to go into 2026.
Are there any, well, we talked about the new deductions and provisions. Have you ever heard of any of those, or have you come across any like being completely misunderstood or overestimated?
I mean, there's always that. Just in tax law, because tax law is not clear at all. I always like to state this fact of all the AI platforms passed the bar exam on the first try. They all failed the CPA exam on the first try. And some of them got it right on the second, but still. So tax law is it's not a clear-cut thing. So there's always things. I will say social media has become kind of my enemy. I think a lot of physicians will agree with me on that stance. But social media will always kind of like, I saw one time, it was basically writing off their pet as a business deduction because it was security animal. I'm going to tell you right now, if Fluffy is laid up on the couch chewing on a rawhide, he's not a security animal. So don't try and do those things. So there's always going to be plenty of things. So if you come across something, you're like, hey, I think this might work. What do you think? And the advisor says, don't do it. That's tax fraud. Then don't do it, please. But there's just plenty of things out there that are all going to be misunderstood and overestimated. A lot of people, I can tell you with the car interest deduction, no one's really checking to see if it's a U.S. assembled car. But when we get to the tax return, that form is going to have us put in the VIN, which then is going to be tracked to see if it's actually U.S. assembled, if you get that deduction. So those are things like that we run into. Also keep in mind the credits for solar panels and residential energy are going to be gone in 2026. There was, they were already on the decline as it was, but they're for real gone in 2026. So if you're going to buy, I don't want to say this, but buy, a refrigerator for a Christmas gift, and fellows, your wife will hate a refrigerator for a Christmas gift. So don't do it. Make sure it's energy proficient. That way you do get the credit, but make it a joint decision, not a Christmas gift.
And then to kind of wrap things up, can you think of just like the top action items you could give individuals and families to consider before year end?
Review your finances before year end. Another one I didn't touch on, make sure you take your required minimum distribution. because you have to do that by year end if you're in your RMD era. So that one's a big one, including your inherited IRA one. If you have an inherited IRA, make sure you take the money out. So those are reviewing and estimating. Even if you don't have an advisor, there's plenty of tools on the IRS website. I know a lot of people don't trust the IRS, but their website actually does have legit sources and information and tools.
It's okay to not trust the people, just trust the website.
Yeah. I would even use like their withholding calculator a lot of times because it's pretty accurate. So those are things to do. Business owners review, look at over everything. If you think you can go buy that new truck and you can justify it as a business asset, go ahead, go buy the truck if you want, or just be prepared to write a check to the government. It's kind of up to you on that side. And I will say paying taxes isn't necessarily the most evil thing. That means that you made money. So you remember, you're only losing a percentage, not all of it.
And to kind of go back on those RMDs, when she was saying that you need to make sure you take money out, listen, there's different rules for RMD, for the inherited IRAs. Okay. So whether you got it before 2019 or after, whether it was inherited from your spouse, previous spouse, or a different family member or whoever, there's different rules for different situations. Make sure if you're unsure of what you should be doing with your inherited IRA, ask somebody. Please go out and ask somebody, because those things get screwed up all the time or get ignored a lot of the time. So if you have an inherited IRA, no matter who it came from, just ask somebody that you trust what you should be doing with it. Another great presentation. Thank you, Rachel. Thank you again for sharing all your insight today. For everybody listening, if today raised questions for you on anything specific to your situation, I think the most effective next step is just to coordinate a planning conversation, whether it be with your tax advisor, your financial advisor, both. If you don't have one, if you want a new one, whatever, just talk with somebody about your taxes, your investments, your estate planning, your long-term strategy. Make sure that they're all working together, okay? Because that is something that people screw up all the time, is they're so focused on one area, or they have advisors in one area that don't talk to their other advisors. Make sure that you have it all coordinated, because it all affects each other. I want to thank everybody for taking the time to come here. Appreciate you joining us. If you have any other questions, we're going to stick around for a little bit to answer any questions, 5 or 10 minutes or so. But if you have any questions beyond that, please feel free to reach out to either one of us. We would be happy to answer, happy to help you in any way that we can. And thank you again for coming. Have a great rest of your day, great rest of your year, and happy holidays, everybody.